Okay, well, good afternoon, everybody, or good morning, I guess, if you're on the West Coast or Mountain Time. But thank you all so much for joining us today. We've actually got a really, really unique presentation today going over solar infrastructure and specifically investment opportunities in the solar field. So we've got Chad Evans here from Overlay Capital to talk to y'all a little bit about that today. Just to give y'all some background on Chad as well, he is a managing partner and CIO of Overlay Capital. So they're an Atlanta-based asset manager with their primary responsibility for Chad being the firm's investment activities and strategy. And prior to Overlay, Chad was actually the CEO and founder of Altera, I believe I'm pronouncing that correctly, which was a lower middle market investment manager. And so throughout his career, this has kind of been his niche, right? And has held numerous investment roles and board positions with different companies and managing investment funds. Chad's professional interest is advancing capital markets through lively discussion and taking the long view. And he is also a holder of the CFA and CAIA charter. So we'll bring Chad up here in just a moment, but I am extremely excited to listen to this presentation. This is a more unique take on alternative investments and something that we don't get to hear about very often. So hopefully y'all are all excited for this. So energizing your portfolio, investment opportunities in solar infrastructure. A very quick disclaimer before we do get started. This presentation purely is for educational purposes, right? If y'all are, longtime viewers of our webinars, or if this is the first time that you're hearing this or seeing some of our presentations. So Quest does not provide any sort of tax, legal, investment, or deal structuring advice. You may have heard this before if you're a longtime listener. We don't necessarily endorse any particular services, investment sponsors, products, anything like that. So it is purely for your education and hopefully to help you, gain some knowledge in a more, like I said, niche space on the alternative investment side. And with that being said, the last thing I do have to say before we bring Chad up is that any questions y'all have throughout the presentation, please put those down in the comments. I'll be getting those to Chad, maybe some throughout the presentation, and we'll certainly have time for a little bit of Q&A at the end. So without further adu, let's go ahead and bring Chad on with us. Man, thank you so much for taking some time out of your Saturday. We certainly appreciate you joining us and being able to speak to our client base a little bit about solar infrastructure and investment opportunities that lie there.
Absolutely, and thanks for the kind introduction. So so before I get started, I'll just add that was actually a great intro. I'll add a little more about our firm. We are a kind of a boutique asset manager focused on real assets, so physical assets like real estate and infrastructure. And the reason we kind of say we're boutique is we're focused on really lower middle market or the smaller end of the market that is not directly competitive with institutional capital. So we look for niche opportunities, we'll call them kind of under the radar investment ideas that have some longevity to them so we can build an investable strategy around them. So that's what we do. Solar is something I've been investing in and my team's been investing in for 7 or 8 years, which if anyone's familiar with how long solar has been around as an investment opportunity, that's almost 70% of the duration of solar. So even though it doesn't sound very long, we've been in it for a while. So that's who we are. We like doing, kind of educational presentations because it's a great way to kind of just, broaden the aperture for folks and let them in on some of these really unique opportunities. And really, I think the key thing for us is to bring context of, okay, so there's this great idea or this great investment maybe, but why does it make sense in kind of the broader landscape? and why might it make sense for an investor as they're thinking about their portfolio. So, without further ado, we're going to jump into this. Investment opportunities in solar infrastructure. All right, so starting with a question, why invest in solar? So just like any investment, you want to understand the space and then also what's happening today. So what are the, we'll call it the market cycle opportunities with the backdrop of what we think of as secular opportunities, which means things that are kind of happening and unfolding over time. So it's all kind of has to kind of fit together. So when I present this topic, we really spend about 30-40% of the time talking about solar in general, what's happening in energy markets, how do we get here, and then in infrastructure in general. So that's where we're going to start. So what is infrastructure? Well, infrastructure covers a lot of things. If you want to look on Investopedia or on Wikipedia, there's some great definitions, but most of us think of it in a very traditional view that includes stuff like roads and bridges and power plants. Maybe you're thinking about municipal infrastructure, or what a lot of people call social infrastructure, which includes libraries and schools. It's in the last, we'll call it 10, 12 years, the definition has broadened. And it's largely broadened because of technology. So we think it's a really interesting space. I'll tell you why in a second. But solar, or we'll call it energy assets, are a component of infrastructure as an asset class. And one of the most interesting things about infrastructure in general, and solar specifically, is that it is considered to be a pretty low volatility asset class, and it's fairly uncorrelated with equity markets. So with your public stocks and bonds, there's not a very direct relationship. I think uncorrelated probably isn't the perfect term, because almost everything has some amount of correlation, meaning they move together a little bit. There's some kind of relationship, but it's pretty broken. And these infrastructure assets and solar assets typically move in an independent way as compared to equity investments, or stock investments rather. And so most allocators, people who are investing in their own portfolio, or if you're a big institution like a pension fund, you're trying to find investments that are attractive from a return standpoint, but also don't necessarily move with your other investments. So that's really the kind of the first point of why this is interesting. But before we get into solar in general, or I'm sorry, specifically, infrastructure in general is really interesting to us. As an asset class, it's only about 20 years old. And so what we mean by that is, if you were looking at a pie chart of where a pension fund might invest, they're going to, maybe 50-60% of it is public stocks and bonds, and 30-40% of it is private investments. And your kind of main food groups in the private investment world have historically contained real estate. It might be private credit, like think private loans, not a bank lending, but private lenders, private equity, so investing in businesses, buying them out, or taking minority positions in them. And then you might have hedge funds and venture capital. It's all kind of, those are your kind of major food groups. Infrastructure has kind of made its way in, and it's still at the very kind of beginning, we think, of this trajectory of being part of a diversified portfolio. And it's for very good reason that it's new. It's not that it was unpopular 30 years ago. It's that there wasn't a really easy way to invest in what we now think of as classic infrastructure, or even modern infrastructure investments. So what's changed? Well, we'll call it in the 90s, public-private partnerships started taking off in a bigger way. So it's, private investment or private businesses partnering with government entities, whether it's federal, could be state, municipal, and working on projects together. And the motivation behind that is typically twofold. It's to bring in private capital, so you have another funding source other than just a tax base, but also expertise from businesses. Most of us probably would agree that 9 times out of 10, private sector is more efficient at deploying capital and running businesses and operating things, at least in the federal government. So that started happening. And then also about 20 years ago, new technologies were springing up in a bigger way. So think cell towers, telecom, broadband, now rural broadband, that they're now becoming investable. Before that, it was very large utilities of some sort that were kind of think Ma Bell that was controlling these. And as new innovations come along, many times the opportunities to invest in them have been created fully anew, and they're not necessarily stuck in these major utilities and you can't get to them. Private investors can. And then lastly, or maybe second to lastly, energy assets have been able to now be invested in directly. And it's largely because of renewable assets or renewable energy assets. So wind, solar, to a lesser extent, geothermal, now some different types of hydroelectric power, so think water power, have really come on the scene in a way that, as we'll see here shortly in this presentation, is really changed the entire energy landscape. So for all these reasons, infrastructure kind of, has become a thing. And now pension funds and large institutional groups like Harvard Endowment, large, very wealthy families, billion-dollar families, are saying, hey, we've got to have infrastructure. This is an important asset class in the world. It's got a really attractive future. We need to have exposure. So I just think it's a really important factor to think, why would I be investing in solar and where does it fit? It fits in this broader bucket of infrastructure for most people. So some other nice things about infrastructure that make it unique in other ways other than just, hey, it's new. But a lot of these assets kind of have a quasi-monopoly. Partially that's because they're regulated assets. There are other reasons as well. For instance, if you owned, I think it's called the Bright Line in Florida, it's privately owned, right? But it's working with government entities to kind of make this happen. But there's only going to be one high-speed rail going through Florida. So if you own it, you have this quasi-monopoly in effect. The other thing that marks infrastructure assets and makes them more resilient is that typically you have long-term contracted cash flows. That either comes from the fact you actually have a long-term contract, or it's because of this quasi-monopoly. It's very likely that you'll continue getting payments. So kind of the big story here is that we believe that the amount of assets going into infrastructure is going to continue to grow. It's more than quadrupled over the last decade, which kind of shows, hey, there was almost nothing because only 4% of these large institutions are holding it, right? So, or rather, of large institutions, about what they typically hold is 4%. So it was almost nothing prior to 10 years ago. Lastly, and we hit on this earlier, usually you're seeing pretty low correlation with other asset classes, which is very much a reason to own infrastructure in general, and that reduces risk. All right, so real quick on energy, maybe everybody knows this, but I just like to cover it real quick. It's a history of our grid, or history of we'll call it electric power. In the late 1800s, it really was dominated by hydroelectric, so large dams, and coal-fired plants. In the mid last century, gas-fired nuclear really came on the scene in a big way. In the 80s, wind power became efficient enough the way it was a major contributor to the grid, and then solar power in the 1990s. And it's really been in the last 15 years, 20 years that wind and solar actually matter as a percentage of our grid. Now, renewables dominate about 25% of our national grid in the United States. So that usually surprises people. They think it's a lot less than that, but it's wind, solar, and hydro assets are about 25%. And then most recently, energy storage has come on the scene and become efficient enough to give it its own story and trajectory. A lot of that is coming from the fact we have introduced so many intermittent power sources like solar and wind into the grid. And worth kind of a side comment here, solar and wind are actually very fantastic contributors from a power production standpoint, but they have one flaw, and that is they're intermittent power sources. So if you look at the levelized cost of electricity, so if you kind of balance everything out, you strip out all incentives from everything, solar in many states is the cheapest form of power, or solar and wind. However, they can't provide all the power needs of a city, right? Because they can't produce baseload power that is reliable and continuous. And so you need storage assets so that when you're overproducing in the daytime or when the wind's blowing, you can save it for later when the demand is peaking. Lastly, you'll see these 3 bullets on the screen. These, I don't know why I said small scale. It should say small scale nuclear, but most academics and private investors believe that nuclear fusion and certainly small scale nuclear, if the regulations are right, are going to be a big part of our energy mix in the future. So here again, another important backdrop point here. By 2050, we need to double in the United States the amount of energy generation we have to the grid. So that's kind of all this chart's about, but that is a big number. We're already top power producer in the world. We need to double it. Solar's major focus. The additions already have grown immensely. If you can see the chart on the right, from 2018 to 2023, we've more than doubled. We got double and a half from there, and we expect to double again or nearly double again between from 2022 to 2028. So from additions of new solar coming in. So this is a big story. Here again, if you're participating in energy and you're saying, I want to own, oil and gas, or I want to own pipelines, what's coming and what's new is renewables. So for the time being, if you're playing in the energy markets, you've got to have some exposure to solar and wind. Made this comment earlier. This is something that often is a misnomer when we talk to folks, but solar is oftentimes the cheapest form of power in the United States. And that's if you strip out all incentives to all producing assets. So a lot of times I added this slide in here a little while ago because a lot of people don't know what we're talking about. And I realized people say, what do you mean? Are you talking about on a roof? Yes, solar includes rooftop solar, but for the most part, what we are looking at from an investment standpoint and what investors are looking at are large arrays of solar. So these larger fields or power plants, depending upon where you are in the country, you may have seen them driving down the interstate, or if you're out west, there are very, very large tracts of land, really in the desert or in kind of rural areas that are dominated by solar panels. And so that's what we're talking about. For reference, and these are round estimates, it depends on where you are, a megawatt of solar usually takes up 3 or 4 acres of land, just to visualize what we're saying. So 3 or 4 acres equals a megawatt, and a megawatt can power roughly 500 to 1,000 homes, just round numbers. So you get some visual of what this is. Battery storage, kind of a new thing. The batteries are just now getting efficient enough, and from a cost standpoint, to really provide grid level storage and also localized storage to like a data center. But those are battery assets there on the right. All right, so that's what we're talking about. It's a very active market. It's big, it's liquid. Institutions are all over it, but that's not what we really do. So part of the second part of the presentation is somewhat general, but it's getting a little more specific into the part of the market we know best and can speak more with a lot more authority on. But you can play this opportunity a few different ways. There's very large funds, and I don't represent these funds, so I feel I'm going to reference them. But like Brookfield has a large fund. BlackRock just bought a large infrastructure fund provider. So there's very large multi-billion-dollar funds that are investing in solar, the future of energy, grid opportunities to upgrade the grid. So this is not by any means the only way to do it is to go small, but we think some of the most attractive returns actually are those that are found in the small end of the market. So one of the kind of next big point is that smaller developers, and what I mean by developers is they're the people who professionally go out and identify land where it's near a substation. A substation is kind of, I think, local grid. So you've probably seen them maybe they're around, near your neighborhood. There could be near a retail area. They're usually where power is needed. So you'll see small substation. It's kind of the local grid. So the developers are looking for land that's proximate to these substations where they can find the intersection of cheap enough land, flat enough land with the right regulations to say, hey, let's build a solar project here. And so that's what I mean by developers, though. It's the groups that go out and identify these opportunities and then construct the projects. So smaller developers need capital to build these projects. And so there's a clear need. The market is very strong. We think for the next 3 or 4 years, smaller developers are going to really benefit from a lot of the legislation that's come through in 2022 and in the overwhelming demand from larger buyers to acquire these kinds of assets. So we want to support them. And right now, the capital needs they have are not being well addressed by traditional lenders, by traditional lenders being banks in most cases. So we think there's a funding gap that is very clear. So why is that? So this chart, by the way, is just a chart of kind of the timeline of a project and where the risk sits and where project cost and project value kind of track. But the point here is that most of these developments that we would call lower middle market or the fragmented part of the market are, let's say sub $20 million transactions. So from the developer standpoint, they may only need $2, $3, $4, $5 million before they sell it to the next party that's going to fully construct the assets and operate them. So right here in the middle of this chart, you see development section on the left. That's what we're funding, or that's what we think is interesting to fund, I should say, is these developers that they're going to sell it and have someone else finish the construction. They're relatively small. So here again, 2 million, maybe up to $4 or $5 million of investment needed. But it's for a pretty short amount of time. This might be 12, 14 months before they're selling it off. And so because it's relatively small and these developers are fragmented across the country, they don't have a lot of access to the banks that are wanting exposure to this. For instance, SVB or Silicon Valley Bank, many of you probably are aware of, they last year got effectively taken over and sold to another bank. They were one of the more active banks in this area. And so in the process of kind of getting taken over and sold, they've really been kind of brought to their knees as far as their ability or interest in investing in a lot of areas they used to participate in. And so along with that and with banks kind of shoring up their capital base in response to interest rates and real estate pressures, there's just not as much lending going on. But at the same time, the market for solar has 4x'd in the last 2 years. So since mid-2022, it's 4 times larger as far as the amount of projects that are in queue. And if you recall back earlier, we've actually probably doubled the amount that's actually gone into operation, but the demand is about 4x. So it's this early stage here that we're focused on because that's where the need is greatest. Real quick though, and let's focus probably on this chart to the right. Most of the money going into global infrastructure, including solar, is coming in from major large funds. So if you look at the totals on the left-hand column and you look at the size of funds on the right, the 10 billion or larger dominates, right? So there's 70 billion, which if you add everything else up, it's not 70 billion or nearly is all $10 billion plus funds. So when they're doing deals, they have to do very large deals. Some of these deals, in fact, are $500 million to $1 billion. So that is part of the market that's most efficient. It has the lowest, the funds that are participating in that part of the market. They have really cheap debt. They're able to do things at scale. But actually, the returns are, in our view, we think lower than what you can get in the low end of the market, primarily because there's just less participation. And that's not a new phenomenon. That's actually pretty common across most asset classes in private equity. So to kind of summarize, the opportunities we believe most attractive in the smaller end of the market, and it's really that case because most banks aren't going to go there. Wells Fargo is not really going to go there. It's just not big enough opportunities. And the equity investors are focused on really big opportunities because they have to be, because they've raised billions of dollars. All right, so if we're thinking as investors, we're thinking, how do I achieve attractive returns, right? For this in this relatively low risk asset class, we believe it's very possible, and you can do so in a diversified way. Meaning, it's not like, hey, I have to find this one deal to invest in. There's actually ways through funds or through other kind of programmatic structures to participate in this opportunity in a way that kind of reduces your kind of market, your systematic risk. Before I jump into that, I think here again, it's worth a little bit of education around what has historically or traditionally been where people invest. What are the different ways to invest and get access to these markets? And what has historically been over the last few years, return expectations. And I keep saying historical or traditional because we think there's pockets inside there where there's excess return, or the same return but much lower risk than most people would expect. So these are your kind of the buckets, or we think of as capital stack tranches, are tax equity, and debt. Tax equity exists because of what we're going to talk about in a second. The Inflation Reduction Act, and even prior to that, there was legislation that provided these federal tax credits to owners or operators of solar projects, wind projects, geothermal, battery. And so in order to access that, you needed to, most developers would piece together a capital stack of just regular old investors. They need a loan from a bank or whoever would provide them a loan, and the tax equity, which is unique in that what the investors are primarily getting when they invest is not a return in the traditional sense, like a cash flow stream or a payment on the back end. Most of it's coming from accessing these tax credits. So they call them tax equity because it is an equity investor, but most of the benefits are kind of structured. And to tax equity, it's 10 to 15% so far. What most people experience in the markets. We think there's an opportunity to identify where the greatest need is, which is with developers actually, and fund their needs directly. So our expectations are a little different. I mentioned this a second ago. For those of you who are not familiar with the Inflation Reduction Act, a lot of the money it certainly is supposed to go to reducing inflation, or that's the headline print, but it went into boosting certain sectors in the United States. And so a lot of it, actually the vast majority of it, went to clean energy. And the here again, the headline print was 250 billion or so. But in reality, there's been a number of kind of assessments. Goldman Sachs did a big one, where it's the effect or the real dollars that are going to be injected into the sector is more like $1 trillion. And it's because there were not caps on elements of this. So from what we're already seeing, it could be $1 trillion, $1.2 trillion, which by the way, kind of worth mentioning, that is a huge amount of money to be going into any sector, any vertical or industry in the United States, much even worldwide, much less a very focused area, which is clean energy. So, if for those who recall 2009 and 10 and all the TARP funding, those were in the $1 trillion range, right? Trillion, $1.2 trillion, $2 trillion. And that amount of money was to save our entire financial system. So think about propping up all the banks in the United States. That's how much money we needed to bail out our economy. That's how much is going in potentially into just clean energy over the next few years. So it's a huge story that is very investable. I'll just note tax credits before the Inflation Reduction Act got passed. There was an ITC or a tax credit for solar. It's been around for 6-7 years prior, but it got expanded. So it used to be 26%. Now it got up to 30% for all projects. And then we also introduced 3 other opportunities to add 10% each. So theoretically, you could get as much as 60% of the cost of your project back. And so what was already a good project might have become a great project or even an amazing project from a return standpoint just from the introduction of these tax credits. It also we also increased the runway on these incentives for 10 years. So the question I always get, of course, is what are the chances that this gets rolled back if we have a less favorable policy interest in Congress or at the presidential level? We think it's very low chance that this gets rolled back. It's just the short version. We think it is possible and maybe even likely, if that's the case, that coal or some other more carbon-based interests get supported. But at this point, clean energy is such a dominant part of our power production, and we need so much more power in the United States. We just don't see it happening. And many of the states that are the most active in the clean energy transition, or I should say the energy transition, are states that are considered to be more conservative, like Texas. Texas, in fact, I think last year overtook California as the biggest install base of renewable energy. So people who were oil and gas folks are now also in renewables, and many of the utilities actually are some of the biggest utilities, and oil and gas companies are some of the biggest recipients of investment tax credits from clean energy because they're participating in the space as well. So this is certainly becoming more of a bipartisan topic. Okay, so how do we make money as investors in the small end of the market, or why? What's creating the opportunity for that? It's local market knowledge, really. So every state is different. The different regions we have, our grid in the United States is broken up into a few regions, and so those regions are specific. The states and local government is all specific. So what we do is partner with groups that know their area. They know Illinois and the programs that exist in Illinois. They know the regulatory environment in New York. And so, you can kind of invest across the spectrum of, let's go to a place like New York, for instance, that has been around for a long time, but the negative is its land's getting harder to acquire. So you can have a position say, okay, I'm going to go with the developers who know it best, that can still find projects and get them done. I know there's a big demand on the exit and there's no policy risk, but more competitive. Versus Illinois, which is still kind of a newer market. They have a program that's been in place. There's plenty of precedent and very little policy risk, if any, but it's still more wide open. There's a lot more opportunity. So for us, we like kind of mixing it up and having some exposure here and some exposure there. But the key idea is you're partnering with developers that know their markets, and that's really what you're extracting, is that local market knowledge and benefiting from it. So this is just a chart to say, kind of, here's some different things we think about as far as where we want to position if we were going to be investing or lending to this market. Like I said, developed markets versus emerging markets, operations. You can invest after the projects are complete. You can invest like we like to invest with developers, so which would be greenfield. So all of these kind of, there's different ways to think about picking your spots. We're going to talk a little more about investing. Well, I actually think I'm missing a chart or missing a slide here. We're going to talk a little more about what we do here, and I'm going to do it without a slide. But one of the most unique spots we found to invest this year, and we saw it kind of unfolding over the last couple of years, is in a part of the market called interconnection deposits. So when you're building a project, you get it under contract. You get the land under contract. It's typically raw land. It could be rural, could just be fallow. Maybe it was agricultural, but now it's fallow, or we're turning agricultural land into a solar project. But the way it works is the developer gets the project under control, or the land under control. They have to make sure it has the permitting it needs and the entitlements or the zoning. So they're allowed to actually do this. And then they get feasibility studies done to make sure the cost isn't too great to interconnect your power plant with the local grid, with the substation. So the way you do that is you work with the utility. So the utility, I'm down in Georgia, so it'd be Southern Company, but you'd be working with Georgia Power or Southern Company to analyze this to price out what the cost would be to run trunk lines to interconnect this project. Well, after they do that and they say, okay, it's going to be $1 million or $1.2 million, whatever the number is, they tell the developer, said, that's great, you're approved, we'll put you in queue, but we need you to put up that $1.2 million today, right? So that's a pretty big number. If y'all will recall, early on in the project, the developer has about $4 or $5 million maybe that they've put out in a $20 million project before they sell it. So $1 million or $1.5 million is a big part of that. And so what we found very attractive is we can lend capital to these developers on the project once they've started some construction, maybe some what we think of as horizontal development, like moving some dirt, putting up fences, starting to do some of the construction. But this interconnection piece, we built a strategy around specifically, and we think it's an interesting place that others might be able to take advantage of, because these deposits that are sitting with the utility, with Georgia Power or whoever it may be, are fully refundable. So if you're lending at 15% on a deposit that's sitting there, and the project, something goes wrong, well, you get all your money back for sure, and the developer still owes you the interest, and they have other projects that serve as collateral for that interest as well. So we think it's really unique because it's protected to the downside. So it's very, very low risk of losing our capital, or the part of our capital that's associated with these deposits. But there's still an attractive upside of it, 15% or more. And that really is a result of the developers are this is a great time to be a solar developer if you know your markets. You could do a lot of projects, but we help them extend their balance sheet by being a capital provider to them too, which allows them to do more projects. And that's really their goal, is do high quality projects, do as many as you can over the next 3 or 4 or 5 years. So I'll stop there. I think we're about 40 minutes in or so. And I think we're going to do Q&A, but I'll take cues from our hosts.
All right. Awesome. Well, thank you so much, Chad. That was fantastic. Certainly very informative. So right quick before we do go into the Q&A, there's a few things I do want to share just about Quest, some of the events we have coming up, and specifically about our services and how you can, potentially use a self-directed IRA to kind of make some investments, and specifically into solar infrastructure, doing some investments on like what Chad is describing, right? So I implore anybody who has questions, interested in, a consultation. We are, completely free if you'd like to set up an initial meeting just to kind of figure out maybe what makes sense. If you have questions, we'd love to answer them, whether it be myself, one of the other IRA specialists here at Quest. I do encourage us to take advantage of that. In fact, you can scan that QR code to schedule an appointment and learn a little bit more about how we can help you, move towards the path of financial growth and alternative investments, and specifically through using your retirement funds. The last thing I do have here as well, the Quest Expo. So if y'all have not heard somebody talk about or read about the Expo yet, this is going to be another great event that we are putting on towards the end of June. It'll be the 27th through the 29th. It's a Thursday through Saturday. It's going to be in the Dallas-Fort Worth area, specifically in Irving, Texas, at the Las Colinas Convention Center. If you're local to Dallas or Fort Worth, you may be familiar with that area and that venue. It's a wonderful spot. And we are going to have, a plethora of all sorts of different alternative investment topics, self-directed and solo 401k discussions. There's going to be a whole lot here, vendors and investment sponsors and people to network with, right? Other attendees, the sponsors that are actually at the event. So whether you are just brand new to the landscape, or maybe you have a ton of experience under your belt, regardless of what your investment interests are, this really is the place for everybody. I mean, we're going to have, like I mentioned, all sorts of different topics and presentations and panels there. We're flying in, speakers and experts from across the country. So really encourage y'all to take a look at this one as well. And there's not a better time to buy tickets than right now. We are offering them for 50% off. Our general admission tickets are $450 and the VIP tickets are $850 for full price. So 50% off of that. Only for a limited time. It's going to be the first, and this is something we started, I guess probably a couple weeks ago, but for the first 150 tickets. So that's actually almost closed out, I think, fairly soon now. So take advantage while you can. This is by far the biggest promotion that we'll have, and there may not be another after this. So if you have any interest at all, again, you can call us, schedule a meeting. We're happy to discuss more about what the agenda looks like and things like that. You can also find that information on our website. If you navigate to the events page, there is a whole page dedicated to the expo there. And I think we also have a video that we can play. Isaac, I'm not sure if we're ready to throw that up yet or not.
Right here, right now.
So we are here because we want to meet as many investors as we possibly can. Quest does a great job of putting people here at the event. This event, I think, is great for first-time borrowers, first-time investors, and experienced investors. This event is great for finding funds that could fit their investment needs. I get a lot of business from the Quest event. I talk to people, I network with people, and it actually becomes business after the event.
Awesome. So that's just a little sneak peek of the expo. That's kind of some footage that we took from the 2022 expo. It really is a ton of fun. The atmosphere is fantastic. You learn a lot. You network with a bunch of great people. So the value is absolutely there. Really, really highly recommend y'all take a look at joining us at the Quest Expo. And I think that's all I have for Quest announcements. Yeah. So Chad, I actually don't see that we had any questions come through. And I know you maybe wanted to take an opportunity to speak a little bit more maybe about y'all's offerings, what kind of services you offer to investors as well. Could you maybe speak more to that?
Yeah, sure. So I think one of the things I kind of skipped because that's probably relevant is, from a return standpoint, and this isn't specific to our fund or anything we're doing, but we think there's an opportunity to make kind of a high teens return here. So I know I threw up a slide that talked about historic returns or what market expectations are. A lot of that's really was geared towards a more institutional size market. The part we play in, our job really is to go find kind of the nuggets, right? It's to find the sweet spot in the markets, and that's why we exist. And frankly, if we didn't do a very good job at that over time, we wouldn't have a job at all. So, but that's so I guess that's one point, is that this is really kind of we're looking for mid-teens type returns or even high teens for what we view as low to moderate risk. As far as for investors, really across our platform, what we do, we have a couple of different formats and ways to invest. People can invest directly with us, meaning, or rather I should say, on direct deals. Funds that work for accredited investors. We also have funds for qualified purchasers. So there's kind of just view it as like different tier levels. We've always taken the approach that, we want to be easy to work with. So our operations department and kind of the way we're set up as a firm is to be able to work well with IRA providers, registered investment advisors like wealth planners and wealth management firms. We've always been successful at engaging with these groups. So we're friendly for direct investors, and we're friendly to institutions alike, which we also have as investors. So I think that's probably the summary point. We're in the middle of raising capital for these type strategies right now. There'll be about a window of a year where we're going to primarily be bringing capital for these kinds of things. And I'm sure we'll continue being in the space, but our strategy will modify over time in response to the market opportunity.
Absolutely. Yeah. Love that. One question we did have come through here while you were speaking, is there a minimum amount to invest?
Yeah, I believe we set it for IRA investors at either 50 or 100,000. I just don't, that's the one thing I don't have in front of me. So yes, it's in our funds, in both of them, I believe it's either 50 or 100,000, and they might be slightly different between them, which I just highlight that's pretty low. Most funds, even at our size, have a $250,000 minimum, if not higher. So it's a reflection of our historic interest in working with IRA providers and wealth advisory shops.
Wonderful. And if you shared it in the presentation, I didn't get a chance to jot it down. What would be the best way for potential investors to reach out to you or contact your team? Is there a website?
Yeah, I mean, we monitor the I think it's investor relations, or it's IR for investor relations at overlaycapital.com, which is right here on the screen also. So that's probably the best way, and it'll quickly get to me. We have a team of 15, so it won't. Someone will directly connect those. If it's questions, they'll get to me or someone on my team, and we'll get them replied to.
Perfect. Okay, and Rebecca just shared that in the chat as well. I wanted to make sure we got it in the comments.
Yeah.
So wonderful.
One thing my colleague just reminded me that I didn't mention, our capital call structure. I don't know how. So in our funds, it is a capital call structure. So the first call, like for instance, if someone said I'm committing $100,000, it might be like 30% that comes in today, and the rest gets called over about a year period. So it's not all at once. It's over time, which is pretty common for our industry.
Okay, perfect.
Yep.
Well, I guess that kind of brings us to a closing here a little bit early. Let everybody get on and enjoy the rest of their Saturdays. Is there any kind of closing remarks or anything like that you have, Chad, to leave us with today?
No, just I think actually I'll make one closing remark, and that's if you're I'm a nerd. I like capital allocation. This is I think about portfolio structure, both my own and the people we work with all the time, and I think looking around the corner, there's going to be a lot of opportunities in infrastructure over the next 20, 30 years globally. There was a stat I read in, I think, the Financial Times a couple weeks ago that said something like, according to a number of different estimates, that 70% of the infrastructure that will exist in 2050 worldwide has yet to be built. So
wow. You're
looking for a big market that no matter what the political environment is, even no matter what the geopolitical environment is, that you can kind of rely on and has some resiliency. I think infrastructure is the place where it is, and solar is just a component of that. So I think for those who are interested in learning more, I might direct their attention to that.
Did you say by 2025 or 2030?
No, 2050. By 2050.
Oh,
2050. I think I got the stat right. It's not in front of me, but it was something like 70% of the infrastructure that exists, like the worldwide infrastructure, or at least the value of it in dollars, it does not exist yet today. So it is yet to be built. And so we have about, 26 years to build more infrastructure than actually exists even today. So we're talking trillions and trillions of dollars. And there's different elements of it, of course, because there's different pockets of infrastructure, but as an idea or as an investment theme, I think it's a really compelling one. And it's not just us saying that. I mean, BlackRock just bought, I think it was Global Infrastructure Partners for, I forget, $12 billion, which is a fund manager in the space. They're doing so because they believe that's where the world's going. They believe that's where investor dollars will go, because that's where the opportunity is. So,
yeah, a lot of great indicators there. Certainly.
Yep.
All right. Well, I think nothing. Oh, we did have one other question. I have land and want to have a community solar farm on it in Galveston County. Is there a way to bridge the gap between landowner and you guys that do the funding?
Interesting. I assume it's Galveston, Texas. So there's an active, that's a real market. Yeah, I think that usually we are contacted by the developers. So usually what I recommend is find a local developer, and most cities and states have a solar association. And so where I would start, if I'm the landowner, I would find a developer that is active in those markets, which, like I said, you could, with a couple, Google searches, you can probably find some people that you can get in touch with, because the associations are pretty active. and figure out what developers are local. If you already have a developer that you're working with, partnering with, we'd love to talk to them. They can also contact us at the same place. We are actively partnering with new groups. So yeah, that's probably what I do.
Okay. And they said yes in Galveston. It is next to a substation that is being constructed at this time.
Could be a great opportunity. I'd encourage you to look into it. And by the way, community solar or DG, distributed generation, is about 80% of what we do. That is that's what dominates the smaller end of the market. So, yep.
Awesome. Well, Chad, we appreciate all the information, all your wisdom and knowledge that you've imparted today. I mean, it's incredibly beneficial. And like I said earlier, just talking about a very specific form of alternative investing in a way that, could really be growing in the future. So thank you so much for your time, and we appreciate everything.
Thanks, everybody. Appreciate it. Thanks, Colin. Thanks, Isaac.
Absolutely. Enjoy the rest of your Saturdays, everyone.
Yeah.
Take care.